In this section, we'll try and look at how do we create a set of balanced and interlinked financial statements for any particular company. This would also kind of give us an idea about what links where to individual companies in the three financial statements. How do we kind of go about building the cash flow statement? And more importantly, how does every decision taken by the firm essentially impact the three financial statements? Primarily of them, the balance sheet being impacted on both sides of the balance, on both sides, or there is a rearrangement of line items within one side of the balance sheet, right? So let's understand the case first. There's a company which on year zero is sitting with an equity share capital of 5,000 crore, and it's sitting with this 5,000 crore in its bank balance at this point of time, right? Now, they will undertake a few transactions as they go along over the course of the next year or so. And then based on those transactions, we have to identify what happens to their financial statements as we look at them, right? We have the income statement for the next year kind of put in, where we have revenue, cost of goods sold gives us gross profit, revenue minus cost of goods sold giving us gross profit. Then we remove the other operating expenses, depreciation and amortization from them to get EBIT, which is operating profit. We include other income after that, is because other income is from sources, non-operating sources. We remove the interest cost, which is finance cost. We get profit before tax or earnings before tax, on which we would apply a tax of, let's say, 30%, and then we get the net profit number which comes here, right? So broadly, that's the contour of data that we have. On the balance sheet, we have the total liabilities and we have the total assets as well, which are given here. In year zero, before the beginning of year one, all of this balances. Year one is what we have to identify and see what comes there and how do we look at the data there, right? So let's look at some of the stuff, and first try and build the cash flow statement itself. So when you have the cash flow statement built from the indirect method, you start with assuming that everything in the P&L statement has been recovered, all the sales have been received, and everything that you had to spend, you have already paid that out as well, right? If you combine these two, then you assume that your net profit is the number from where you should start building your cash flow, right? Now, in your profit and loss account, note that depreciation and amortization is a non-cash expense that has been cut out, but it was never really paid that year. It's like you bought a car for 10 lakhs and expensed about 1 lakh of that value in the first year, but the actual outflow was 10 lakhs. It wasn't 1 lakh, right? So you add the depreciation slash amortization. You add this, right? Now remember, it is assumed that all the sales have been recovered, which means whatever is sold has already come into the firm. If that has not happened, practically when we started with the assumption around net profit, we assumed that all sales have been received and all payments have been made. Now let's say sales have not been received. What would that mean? That will mean that receivables would have gone up, right? Our receivables would have gone up, correct? So we will have to find out if there is an increase in receivables. If there is an increase in receivables, that should ideally be subtracted from my net profit number, because the net profit assumes that all the sales have been received, correct? So less increase in receivables, right? Similarly, it assumes that all the inventory has been sold off. If the inventory has not been sold off, there is cash that has been tied up there, right? So you spend some money trying to get some stuff, and then you are not able to sell it. So that again is cash getting blocked. So less increase in inventory. And now think about it, if you have not paid the money to someone, when you started the cash flow with the net profit number, your assumption was all sales have been materialized and they have been received, and all payments have been made. If sales have not been done, that's included here. But if payments have not been done, you've already accounted for money going out. That money did not go out, which means you have to add any increase in current liabilities, right? Once you do these, you get what is typically called as cash flow from operation. So I can put the formula here. It says net profit plus depreciation minus increase in receivables minus increase in inventory and plus increase in current liabilities. That gives me my cash flow from operations. Next one is cash flow from investing activities. Now remember, anything that comes into the firm is an inflow. Anything that goes out of the firm is an outflow. So you would have spent money in the form of capital expenditure. That's an outflow, right? So that's one line item that comes in. The second one is if you have done any kind of investments, net investments. Have you bought something or have you sold something, right? So that comes here and your cash flow from investing becomes, what I will do is I'll put a negative number here and then add these two. Why did I put a negative number here is because this is, if there is a capital expenditure of 1000 crore, that's an outflow, right? The outflow has to come here as minus 1000. So that's what we have kind of taken here. I put a negative number there. And then we go to cash flow from financing activities where you add any change in debt, you add any change in equity of the firm, whether the firm has raised money on equity, and you remove any dividends paid. So what we get eventually is change in debt plus change in equity minus any dividends paid, and that gives us a zero number as well, right? To the end, we get cash flow for the year, and this should add up to be cash flow from operations plus cash flow from investing. Remember, we've already taken the negative sign in cash flow from investing plus cash flow from financing, right? So that's how we basically arrive at this number, and we basically kind of link all this in, right? This linkage, then we can take all this set of data and format it once again. They don't seem to be in the same format, so we'll plug them in the same format, right? Now we have a working model that is there. We need to plug in the data that is available to us in the form of any kind of business details, right? Let's look at those business details. There are certain steps of business during the year. So let's see what are these business steps. We will look at the fact that and we'll take them chronologically, assuming that the company has raised 2000 crore as long-term loans. That's the first thing, and they're doing it right at the beginning of the year, right? So the company raises 2000 crore as long-term loans. Where should this come and fit in? Long-term loans were 0 here. They should become 2000 here. So this is going to be 2000. Correct? Obviously, if this is 2000, there has to be a commensurate change on the other side of the balance sheet. Where did this money go, right, when it comes in? So how does that money come in? You remember that this comes in the change in debt. So what is the change in debt? 2000 minus the last year number, correct? So you put in this 2000, you find that we have the debt number established, which at the end of the year, we started with a cash flow of 5,000, yearly cash flow was 2,000, ending cash is 7,000. This ending cash should come and link itself to the ending cash on the balance sheet, right? There is a small check line item here that tells you that the balance sheet is balanced, right? Now we kind of go ahead and look at the next line item that comes in, and these 2000 crore of loans have an interest rate of 10%, which basically means there's going to be a finance cost of 200 crores right away, correct? So a finance cost of 200 crores comes right away. That reduces the net profit number, right? Obviously, because 200 crore is going out at the end of the year, That should reflect in the cash flow in the form of the net profit, which we will put an equals to sign and link it directly to the net profit number. Remember, we are linking numbers so that we have a completely dynamic model. So this 200 goes out, which results in the net cash flow for the year only being 1800, thereby ending cash being 6800. Right now, there is a mismatch in the balance sheet of 200. Is because on the liabilities side also this 200 has to be paid out by someone, right? Who pays this 200? Equity holders pay this this 200. So reserves and surplus is last year reserves and surplus plus any undistributed profits. The equity holder value last year was the sum of these two. That's 5,000. This year that's become the sum of these two, which is 4,800. That's because 200 has been paid out by the equity holders, correct? So that brings us to an end of the first step in the business. The company buys plant and machinery worth 4,000 crore to begin operations. Now, where does this come in? This comes in the form of gross block, long-term assets. So we put in 4,000 crore here. That's what the company buys, right? Obviously, if the company buys this, there is a capital expenditure here, and that capital expenditure is 4,000 minus the last year number, which is 0. So you get 4,000. And obviously, because 4,000 comes here, your cash number goes down by negative 2,200, goes down to negative 2,200. So you end with 2,800, which comes here. I'll again format this bit as well in the number format so that it all matches. So we see this, but on the P&L side, we don't see these changes happening. On the liability side, there is no change. On the asset side, we have to figure out what happened. Cash went down, but something else should have gone up that did not go up. Right now, it's only recording the cash number, right? How will we record that? We will record that there is going to be some sort of a value erosion that's going to happen in this particular case. What is that value erosion? Let's understand that. So there's going to be some depreciation here, right? If you buy some assets, they're going to get depreciated at 10%, which means your depreciation number comes in at 400. See, profit goes down to minus 600. Cash goes down by another 400. But because you have already lost 400 in depreciation, accumulated depreciation becomes this, which means carrying value of the assets is initial value minus what value you have lost during the year, right? So we arrive at this number, which is 3,600, and we will note that that's the value that has gone out during the year. The balance sheet even now is not kind of balancing, and that is because this 400 is a non-cash outflow. This 2,400 goes out, assuming this 2,400 comes here in the cash statement, assuming depreciation money has gone out, but that never went out, right? That will get sorted if we add the 400 crore of depreciation back, and you will see that now the balance sheet again balances. Fine, cash goes back up to 2,800, and you have reserves and surplus at minus 600 in this case, right? Let's go to the next step. Company invests 500 crore in mutual funds. These are investments, right? So that means you should see a 500 crore here in the balance sheet in investments, and you should see a 500 crore here in investments. So obviously that takes the cash number down. What happens is a rearrangement of items within the block. So eventually you find value going from here to here. This was 2,800. 500 from this went and sat up in the other side, correct? So that gives us the details of what happened on the investment side with the company. Company buys raw materials worth 800 crore. Raw material would initially come and sit in the inventory piece. So we put in the inventory piece here as 800, and that 800 kind of comes in as inventory. There's an increase in inventory. That increase in inventory has to go out in the form of cash because you would have paid cash to take this out, correct? You put in 800 here as well, or you could just link it in the form of 800 minus the last year number. That's slightly better if you link all these data points. Even depreciation, ideally we should go and link it to the P&L statement, right? So we get increase in inventory, and that solves our first part. Let's see if the balance sheet is balanced. It is. There's still the transfer happening from one part of the asset side to another. Cash gets moved into the other segment essentially, right? So that takes care of the inventory concept and what's happened with the inventory as such. Let's look at the next part of the business, which is after converting these raw materials into finished goods, the company is able to sell it for 2300 crore. Now, two things should happen. One, you should generate a revenue of 2300 crore, correct? And the cost of these goods sold is 800 crore. That gives you a gross profit of 1500 crore, right? So two things happen. One, you put in these numbers. The second thing that happens is you've used up the inventory. There's no longer any inventory there. So inventory becomes zero. So there are two things that happen there. You use up the inventory and then you sell it for 2300 crore. So you end up making a gross profit of 1500 crore. Everything else remains the same, but because we have not assumed a tax as yet, we'll bring that in as we go along. Because we have not assumed a tax as yet, that extra 1500 crore of profit, 2300 minus 800, right? The profit comes in because we have assumed sales of 2300 minus 800, that 1500 gets added to this. Remember, it was 6400 before this, plus 1500, that gives us 7900. Also remember, at this point of time we have not assumed any tax. Let's bring in the tax component now, right? So tax, let's assume to be 30% of 900, correct? So that's 620, 270 is the tax, 630 is what is left. Now, from our learnings earlier so far, let's assume that we want a scenario that the tax number should automatically come if there is a profit, but if there is a loss, you should have no tax if loss and taxed if profit. So from our earlier learnings, we should know that we should be able to use the if formula here. So let's change this. What will I do? I will put in an if formula. If profit before tax, and let's write it, if profit before tax is greater than 0, then 30% into profit before tax is the value, else 0 is the value, right? So we get 270 as the answer. Look at the formula once again. If profit before tax is greater than 0, then 30% into profit before tax is the tax value. Otherwise, 0 is the value. So if I put this number as minus 100 for some reason, you see that tax is not calculated there. So automatically we have made a dynamic model here as well, right? So that brings us the fifth equation, which is essentially you're able to sell it. 6 point operating costs are 500 crore. Now, this was only the raw material cost, this 800. There's an operating expense of 500 crore as well, which comes out, right? So operating expense of 500 crore gets added. That means your tax number goes down by 150 crore. Why? Is because expense increases by 500 crore. So the tax amount should go down by 150 crore there, right? That's what happened. We see that the balance sheet still remains balanced. Everything else is kind of linked in the model as yet. Now we realize that some clients have not paid upfront. So the money worth 400 crore is not received. What is this? This is receivables, which means receivables go to 400. You see there is a mismatch in the balance sheet now. So what happens? An increase in receivables means we have not received this cash, which means I need to subtract it from here. So 400 minus the last year number on receivables, and we get that as increase in receivables here, and that gives us balanced balance sheet once again. Remember, there's no change in the values essentially of the total assets, is because we just rewrite these items as we go along. The next one being the company delays the payment of 300 crore to one of its suppliers by 1 year. So what happens to that? you essentially put in what is called as current liabilities. Payables increased by 300 crores, and you have to add current liabilities 300 minus 0. And when you do that, effectively cash flow from operations increase and we have a balance sheet, right? So the cash increases from 7280 to the total assets increase from 7280 to 7580, correct? Just before the year ends, the company chooses to sell investments worth 250 crore. The market value of these investments is now 300 crore. So the first things first, investment sold of 250 crore. So what is left is only 250 crore of investment, correct? This is what is left, correct? And obviously if you sold 250 crore worth of investments, 250 crore will get added to your cash number automatically, and that should come in here is because this investments number we had hard coded. That's the benefit of linking these numbers, 250 minus last year number. And now that we link it, we again find that this 250 crore is added to cash. But what we also note is that the market value of these investments is 300 crore, which means we've made a profit of 50 crore. This is other income. So we add a line item on other income. That 50 crore of other income will increase the tax component by another 15 crore and thereby adding 35 crore to the cash number. That's what ends the balance sheet here. Remember, before this, the balance sheet was at 7580. Now it's 7615. Finally, the company chooses to pay a dividend of 80 crore. So we plug in a dividend number here of 80 crore. Now, the moment we plug in a dividend number here, that's a cash outflow. So dividends go out to that extent, and I link the dividend number here. So cash goes down by 80. What happens on the other side? Dividend is a payout to the shareholder, right? But reserves and surplus is what the shareholder is entitled to. Now here we assume this 315 is because the net profit was 315, correct? But now out of this net profit, we have already paid out the dividend to the shareholder. So the entitlement of the shareholder has to go down by that 80 crore. So you have to subtract this 80 crore from reserves and surplus because this is already gone out, which brings us to a finally balanced balance sheet of 7535. That is what happens to the company's financial statements at the end of the year. That's how you basically go about building a completely linked financial model for a firm. What you will also note is that every time there is a transaction by the firm using any of these line items of the business, you will see that there will be a change across all the three financial statements, and eventually we will end up with a scenario where both sides of the balance sheet end up at the same number. The balance sheet should stay balanced after every transaction that the company takes. Fine. So that's how you kind of build a linked financial model for any company's financials in Excel.